Hello everyone, we are WUSTL team in CQA Investment Challenge. I'm Eden, the leader of the team.
I'm Bella, I am responsible for risk management.
I'm Aurora, I'm responsible for the compliance.
I'm Joshua, I'm the quantitative researcher.
Hi everyone, my name is Hank, I'm responsible for generating data.
Hi, I'm Yimi, and I am the industry researcher.
We just introduced our investment team, and in the following, we will introduce our portfolio in detail. First, investment philosophy and process. Overall, we have constructed in 3 stages. Each stage lasts for approximately 1 month. The first one is close to mean variance way, but we mainly pair our stocks in short and long at the same time. And the second one is momentum strategy. And the last one is mostly event-driven and some industry trend catching. The reason for our shift is because between phase 1 and 2, the return didn't meet our expectation, and for second one, the momentum doesn't apply that well to the special stage in January. The detailed strategy for those 3 will be discussed later in the following. First stage is volatility pairwise allocation. First, we need to screen out 50 short stocks and 50 long stocks, mostly based on their financial ratios, like return on equity, PE ratio, and also their past performance and their corresponding industries. Then we will pair those stocks based on their volatility. That is to match the most volatile short stocks with the most volatile long stocks. And then we're using the mean variance to find the optimal portfolio and run on those pairs and generate the weight for each pair. It has certain flaws, we think, that is that because the rules regulate us to have maximum 5% in each stocks. So sometimes the optimal portfolio may not reach within this range.
After applying volatility pairwise allocation for a while, we realized the return did not achieve our expected level, so we switched our strategy to momentum. Momentum is caused by market anomaly. It claims that in a specific period, the rising asset prices would rise further, while falling prices will keep falling. We want to profit by staying with our observed trends. So we test the performance of momentum strategy based on various periods, including 1 day, 1 week, and 1 month. In phase 3, we adopt the event-driven strategy to feed the market changes. One of our focuses is the publish of financial reports. A financial statement of a particular company not only reflects its value, but also is an indication of its comparable companies in the same industry. For example, when Uber published its financial report this year, we use it to predict the performance of Lyft. We also pay attention to merger and acquisition news, industry trends, and macroeconomic news. For example, we adjusted our portfolio accordingly when the acquisition between T-Mobile and Sprint happened, when there were updated announcements about the trade war, and when the coronavirus broke out. Through the whole competition, we strictly follow the weekly rebalance frequency, and we typically do it on Monday and Friday. Also, we have our own trading policy. First, we select stocks from each industry limited to 25% of market share. Second, we set the stop loss point ranging from 10% to 15%. Thirdly, we do compliance check every Friday. Lastly, we normally holding share at least 1 week.
Regarding our portfolio's expectations, in the first phase, our mean variance strategy generated an annualized return of nearly 8% with an annualized volatility of 23% on 5-year daily data. Under this strategy, look at the haste. The return of strategy followed a normal distribution without obvious outlier returns because this strategy successfully diversified the idiosyncratic risk and generated a more stable return. In the second phase, our momentum strategy can achieve an annualized return of 38% with an annualized volatility of 44% on 10-year daily data. Comparing with our prior strategy, momentum strategy generated more than 5 times return than before with a doubled volatility. The bar chart shows the backtesting return for our second strategy. This strategy could generate a considerable positive return in most years.
See the pie chart. Our portfolio is quite diversified. The top 5 industries we invested are financial, technology, utilities, basic materials, and industrial goods. Our overall return is 2.44%, and the overall Sharpe ratio is 0.02. Meanwhile, the interest rate is 0.61%. Our return reached the peak 4.30% due to the strategy changing in January. That's the reason why we think momentum is our best performance strategy. There's another point we need to clarify is that our overall transaction fee is nearly 30,000, which means if we rebalance less frequently, we can make larger return. Our alpha is 3.99% and overall beta is minus 0.61. So our portfolio can effectively hedge the market risk, especially the downside risk. See the chart, our portfolio outperformed the S&P index in the latest week.
For the portfolio attribution from this exhibit, our portfolio generates a slightly negative return and volatility around 8%. The style factor has a negative attribution to our portfolio, while the industry, market factors, and stock specifications have positive contributions. Plus, the market factor brings us the highest information ratio, about 3.25. Although the overall contribution of style factor is negative, the dividend yield market sensitivity brings our portfolio around positive 1% return in total with high information ratios. All other factors such like size, momentum, value, and growth have less than 0.1% contributions. Except the semiconductor and semiconductor equipment industry, all industries have nearly equal contribution to our portfolio, demonstrating that our portfolio is well diversified. This exhibit shows that the individual stocks that provide the most contributions to our portfolio. All the contributions above are less than 0.05%, indicating that our portfolio is well diversified and will be always immune for the unexpected shock from any individual stocks.
After participating in the CQA trading competition, we gained valuable trading experience and insights. The first key takeaway, which is a fun fact for our portfolio, we earned about $25,000 on one single stock,
Tesla.
The market is far more unpredictable than we thought. Also, the stock market responds to newspaper really fast. We should follow the market and understand it. The dollar-neutral strategy is hard to beat the market as U.S. stock market experienced upward trend. In fact, we lost a lot on the short side, but a lot less volatile. We would really appreciate your listening. Thank you.